Hey everybody, this is Jim Musgrave with Research Financial Strategies. I wanted to thank you for taking time to watch the Q3 2021 market review. Well, there's a lot of exciting things going on, and I'll hit this first. In the news, I've got my website. I've been working on it for over a year and a half. We should have it up by the end of the quarter. And there's a lot of great information on there, so I'll certainly let you know when the brand new website has been released. We continue to do the Social Security webinars, and last month we did our first live seminar, which I was really excited about. So we're going to be doing more live seminars and webinars coming up after Labor Day, and really excited about a new class that I'm teaching. This is actually a master class called the Tax Storm, where I'm going to be covering 5 strategies to help you protect yourself and minimize the tax bite. And kind of related to minimizing taxes, I also want to release a tax efficient portfolio. I've been working with a third company called 55IP. And what 55IP does is that they actually do tax loss harvesting and add, the bottom line is that they reduce the capital gains tax in non-qualified accounts. And so I'm going to be talking to all my clients about that a little bit more in the next couple months. But again, if you have some interest in that, certainly feel free to reach out, and I can tell you a little bit more about our tax efficient portfolios. Okay, so the last 2 market updates, we've given a COVID update, and you can see we were making such great progress, and then boom, this Delta variant has kind of raised its ugly head, which is certainly put a big toll on a lot of the hospitals. And at least where I am in Montgomery County, that we're kind of going back to the mask mandate. But in terms of the markets, again, it hasn't really affected things too much. You can see here, this is more of a longer term chart of the S&P 500, and from where we were March of last year to the end of June, we're up 92%. And again, this slide is about maybe 5 weeks old, but you can see right here that the market just continues to climb. So the variant of the COVID virus hasn't affected the markets, at least as of today. We'll see what happens in the future. So again, S&P is up as of August the 6th over 18%, which is really impressive. And again, I've talked about bonds in the last couple of market updates, and you can see that the bonds are basically down about 2% year to date. And if you look on the far right, you see that big red candlestick on Friday, August the 6th. Well, why did that happen? Well, again, bonds are generated by interest rate yields. And you can look at the 10-year, you can see on Friday, August the 6th, the 10-year jumped to 1.31, where the previous day was at 1.23. So again, when the yield curve goes up, bond prices go down, and that's exactly what happened to the bonds last week. So but you can see that, again, the interest rates have direct correlation on bonds. Keep an eye out on those. Okay, student of the markets. So in this student of the markets, we're going to talk about stock and bond returns, stock market returns, some long-term equity cycles, which is a really kind of fascinating chart. I'm going to share with you what's going on with taxable bond flows. Are passive strategies doing well? Active management going well in bonds? Well, we'll see. And again, we got to talk about inflation, because that's the real story going on right now. So let's kind of talk about the stock and bond returns. And what you can see is that it's actually fairly rare that we have both stocks and bonds doing well at any given time. You can go back to back in history, and when stocks and bonds have both had positive returns, it's only happened 4 times in history. And you look at, here we are in 2021. As you know, bonds are down this year so far. So again, in terms of the statistics that we've seen, that we've never seen 3 years in a row where both stocks and bonds have gone up at the same time. And just to kind of give you an idea how well we're doing in terms of the equities, is that 2021 is the 18th best start to a year for stocks. And that's pretty impressive. And the question is, well, how will it do the rest of the year? Well, on average, in a bull year, the second half does about 6.5%. So if history proves true moving forward. We should have the S&P over 20% at the end of the year. So that'd be a fantastic year for the stock market. And this is a long-term trend, which is really interesting. If you look at the 10-year rolling return going back to 1939, you can see that there's about a 35-year trend between the very low and it peaks, then it drops again. And you can see, so the question is, where are we right now, and how does that compare to past rolling returns? So right now we're about 12 years, 4 months into the cycle after the low, and we're about just under 15% off the lows in February 2009. And you can see going back to January 1987 and December 1951, you can see that we were over 15 and 17% respectively. So it's an interesting chart because you can see kind of on a cyclical basis, we have a lot of room to go to the upside before we kind of hit the resistance and start to come back down. So that's a very, very positive long-term trend right now. So again, as we've said for quite some time now, it's time to be bullish. We have our foot on the gas pedal, and we remain that way. Okay, so there's always been this different point of view of does active management make more sense, or should we go with passive management? And this is a really interesting chart talking about bond funds. And you can see that back in 2011, there were 83% of the bond mutual funds were active versus 17% passive. You can see that the index funds, the bond funds, are really kind of gathering steam, and again, 10 years later, about 35% of the bond funds are actually passive. But you can see through the chart on the right, you can see that both active and passive bond funds are taking in a lot of money. So it's really interesting to kind of see the dynamic. And one thing I want to point out is that whether you take a 100% active management approach or a 100% passive management approach, you're taking a pretty large bet. And one of the things that we feel is that you should kind of barbell your strategies and have both active and passive positions in your portfolio in both the stocks and the bonds. So, but a great chart in terms of talking about the flows of active and passive. And you can see the big story, as we've been talking about for a long time, is inflation. Again, the May inflation numbers were up about 5%. And you can see that the 10-year Treasury is about 1.6. Actually, you saw in just a slide a few slides ago is down to about 1.3. And so what this is really illustrating is that inflation is far greater than a 10-year Treasury. Now, this is a real challenge for retirees on a fixed income. But this also, I keep on hammering this for people who have large positions in cash, who are just very, very, risk adverse. My argument is that you're taking more risk being in a 3-month CD or a 10-year Treasury than you do in the market at this point. And primarily, it's inflation risk that's getting you. So again, there's a huge gap between interest rates and inflation, and that's exactly what we're experiencing right now. So again, if you want to kind of talk about, hey, what should I do with the cash that I have, then let's certainly set up a time and we can kind of talk about that. Okay. And again, the disconnect between housing prices and rents. This is a fascinating chart. Obviously, we know that houses and it's basically a seller's market. I mean, just in my neighborhood, we've had houses that are selling well over the asking price, and we couldn't believe what they sold for. And so again, you can see that the housing prices far exceed the rents that are going up right there, and that is it's adding a lot to the inflation rates. Now, just kind of look at it. There's the quality enhancements can create a disconnect between expenses and inflation. So what's really interesting is that the way that the CPI is calculated, and this is a perfect example. If you look at cable plans, so you had cable plan A, and the cost was $40, and cable plan B was $47. Well, that's an 18% increase. Yeah, and you get some more channels. The interesting thing is that the CPI doesn't base things on the cost that went up from $40 to $47. They base it off of like the cost per channel. So since they added a few more channels in there, the cost per channel went from 56 cents to 59 cents, which is about a 4% reported inflation on the CPI. So again, the CPI isn't necessarily 100% accurate or representative about the true cost of inflation. So again, things may feel a little bit worse than they are. Okay, and again, just kind of looking at overall markets right here. Again, bonds remain down, but overall stocks are doing very well. And again, you can look at the total return over last year for SP 500 is over 40%, which is pretty amazing. So again, the call to action, again, ask about our tax efficient portfolios. And again, happy to talk to you a little more about that. And also register for the upcoming workshops and master classes. We'll be sending out emails probably after Labor Day about the latest workshops in those areas. Again, feel free to schedule a 30-minute call or give me a call, send me an email, or visit my website. So guys, I hope this was helpful to you, and again, hope it's thought-provoking, and again, reach out to me if you have any questions. Happy to answer any questions, review your portfolio, do any kind of reviews, or give you a second opinion. So listen, we're going to go ahead and call this Q3 market update a wrap, and we'll see you Q4. You guys have a great day. Take care.